Okay, so my name is Babatunde Akin-Moses. I'll be taking this session on business valuation simplified. Once again, I apologize for coming late. I had some internet glitches down here, but it's good to be here. So we'll just dive right into it. So on today's agenda, we'll talk a little bit about me. We'll look at what business valuation is. We'll look at the importance of business valuation. We'll look at some methods and tips. And there are some questions that were sent earlier. Those will be answered, and then we can take more questions. So let's talk a little bit about me. So basically, I was born in Lagos, Nigeria. I didn't put born and bred there because I've lived in several states. My parents moved around a lot. Studied economics at Bowen University. I've been working for about a decade now in Shell, KPMG, PwC, all finance related. Last year, I started Sycamore, which is a peer-to-peer lending startup, and we provide business loans to SMEs generally. And I'm also a chartered accountant and an MBA holder from Lagos Business School. And that's me right there, smiling, looking very happy. And yeah, I guess as we go along, I might talk more about my experience and what I've done as it relates to what we are doing now. So we can proceed. So what is business valuation? What is business valuation? Business valuation is essentially the process or set of procedures you use to ascertain the monetary value of your business. It can be a business unit, it can be the entire business, or it can be just your own shares in the business. And the question now really is, what we're going to try to address is, do you know your business valuation? And if you don't, how do you ascertain something that is very reasonable? In the first communique that Glory sent out, she had mentioned that is it an art or a science? And a lot of the questions too were sort of alluding to the fact that this valuation isn't as simple as they think. True, it can be complicated in a way, but it's also an art in that there are no right or wrong answers, right? Usually, the value of something is the price that people pay for it. And as we go along, you see that it's not as straightforward as a lot of people think. And on the other hand, it can also be straightforward depending on how you approach it. So let's look at the importance of business valuation. There was an interesting question that came in and said, apart from selling the business, what else is business valuation used for? Quite honestly, there are a number of things. I believe we get caught up in trying to sell a business because a lot of us are small businessmen or startups, and we're looking to raise money. And so we tend to see business valuation from that perspective. But the truth is, by the time you start to peel back the layers, you see a lot of other things that business valuation is used for. So as I said earlier, the price of what you pay, it depends on the value you put on it. And like Warren Buffett also said, price is what you pay, value is what you get. And so you might pay for something, but are you satisfied all the time that you are getting value out of what you've paid for? So what are some of the importance of business valuation? The obvious one is you may need to sell the business. That is the one we're all familiar with. The other one is you may need financing, debt or equity. Now, if you want to raise a round of investment as a small business or a startup, it's very likely that you get a mix of both. So it's not just equity, but even the amount of debt that you're asking for too, it's mostly going to be around your business value. So if you say, for instance, you are worth 100 million and you're going out to raise maybe 30 million, so 30% of the business, right? Everybody would want to give you that 30% in all equity. Some people might want to give you debt as well, right? So it's also important in raising debt. And then another use is to properly assess a business you want to buy. So imagine you're on the other end now, you're an investor yourself. How do you know that what you're being sold is valuable? How do you make that decision by yourself? It's not always a case of you just trying to sell. Sometimes you might be the buyer, and in reality, we're all buyers, right? Even if we might not know it, because every time we buy equity stocks, we are agreeing to the value of that business at that price every time we buy shares on the stock exchange. So we buy those shares with the expectation that they'll be more valuable in the future, so that we can sell them at a gain, or that those companies will pay dividend. So if we could properly assess some of those prices, then I mean, it's very valuable to us in our everyday life. And also, another use is you want to evaluate the progress of your business. So if you want to see how far you've come, that is more of an exercise for you yourself. Let's say you started a business 3 years ago and you want to know what it's worth compared to what it is now. There was something that happened recently. I don't know if many of us saw the trend on Twitter. There was a farm that was started somewhere in Nasarawa. It's a cooperative, and the Oshibajo visited the farm, and he said something. He said this farm was started with 1.5 million naira, and now the farm is worth 1 billion. And everybody sort of went crazy about it, saying it's not possible. How is that possible? But it's very possible, right? And we see worse in tech startups. What he was trying to say is that is the current value of the entire business. Perhaps the tweet didn't communicate it very well, but the truth is, if it lets you take stock, right, that a business that was started 4 years ago with 1.5 million naira is now worth 1 billion. So it tells you that you've grown X amount of what you started with. So you can also do that exercise for yourself as well and say, oh, this business I started in my living room with 20,000 naira, just internet subscription, now it's worth X amount. So it's a good way to track your progress. Another very interesting importance of business valuation is to manage shareholder disputes. So now what do I mean by shareholder dispute? It's so you want to grow your business. Maybe you started with your friend and you guys were not so rich, but now you are very rich, you're billionaires, and issues happen, and maybe your partner wants to leave the business. Now, how do you value what you're going to give your partner to live with? If let's say you decide to split the business, or if he just wants to cash out and leave, obviously from his own perspective, he would want a very high valuation. He wants to say, oh, our business is worth 1 billion, I own 50%, therefore give me 500 million. And on your own part, you don't want to part away with too much cash, for instance. You would say, oh no, we're just worth 500 million, therefore you should take 250 million. I mean, that's just an example. And if you go to courts, what the judge will want to see is most likely want to see an independent valuation of the business, right? To say, oh, okay, your own value is 1 billion, your own value is 500 million. What did the professional valuation experts, what is their view on how much this value is worth? And most likely, along with all other facts, will determine how much the valuation will finally come to. Another one is to issue stock options to your employees. So this is something, it's not been done so much in Nigeria as it's been done in Silicon Valley and the US and other more advanced nations in general. But one way to lure talent in is to say you give them stock options, which is pretty much giving them ownership of that business. And if you check the stories of all the unicorns, that is the companies that are worth $1 billion and above, you'll see that all their first set of employees are all millionaires, dollar millionaires, because they got stock options for joining early. And that gives them a share of the business. So for instance, you're starting a new business, but you want to employ somebody that is very skilled in a bigger organization. You might not be able to pay a lot in salary, but if you are a smooth talker and a good negotiator, you could basically say, oh, look, I'm going to give you so percent of this business. If we work hard, this business can be the next Facebook or next Microsoft. And it's very useful to sort of give stock options. We're using it more and more every day in Nigeria now. And yeah, there is also to compare with a similar or competing business. There are many reasons you might want to do this. You might want to value your business based on the price of another business. You want to know how well you've done in comparison. You want to know how well, that's how well you are doing overall, really. And we see this a lot, even in the Nigerian space. So it played out a lot in Jumia versus Konga Wars when it was still at its height. People say, oh, why is this one valued at this? Why is this one valued at this? Then people try to look for the sorts of differences. So you can also use valuation to compare how well businesses are doing. Whether or not that is true accurate is, another thing entirely. So we move on. So let's look at methods of business valuation. And basically, the next set of slides will be going through what are the specific methods you can use to value your business. Now, there is a level to which how in-depth we can go in this session, because if you want to do an actual business valuation, you have to get calculators, you need to do some research, and it's something that people have been learning all their lives and continue to learn and improve on every day. But after this set of slides, the idea is that you walk away with a concrete grasp of the methods, at least the most common methods for business valuation. People are coming up with new ones every day. But if you have the basic principles, like somebody asks in the questions, you'll be very, very comfortable. So now, let's dive right into it. So initially, I wanted to stick to the conventional methods for valuation, which is basically what you see on your left if you're looking at the screen. There's the asset base, there's market value, there's cash flow, and there's multiples. But again, I started thinking about what some of the things I've seen in practice, and even the way I raised funds personally we raised funds for our business last year. And I said, what, let's try to make it a bit more interesting, because you come across some of these methods and you say, oh, that's not correct. You didn't use cash flow, you didn't use market value. So these are some of the nuances you start to get when people say, oh, it's both an art and a science. So let's dive right into it. So the asset-based method is really the most common and easiest way to value a business. It's also the fastest, because it's something you can do very, very quickly. It's essentially taking all your assets and subtracting all your liabilities. So for example, for the sake of simplicity, if all you have is a car worth 100,000 naira, that's the only asset you have, and that is the only asset you have. And you've also taken out just one loan in your lifetime of the business. That is maybe 50,000. Your business value would be 100 minus 50, which is assets minus liability. So that gives you what we call net assets in accounting, or the equity value. So when people say your balance sheet did not, well, that's where the name balance sheet really comes from. Because if you've done your accounting right, when you subtract your liabilities from your assets, what you have left should be equal to the equity value that you have. So essentially, that is the price of your business. Now, a lot of people that want high valuations don't typically use this because it might not be so high. So imagine like look at a lot of software companies. They don't have a lot of, they might not have a lot of assets. If they've built some technology and they've put a value around it, it might be sitting in their books as assets. Some of them just don't have assets. Maybe they are still building something. You can't say their business is not valuable because it asset minus liability. But what this does is it gives you a base to say, okay, well, this is my worst case scenario, right? At worst, if I'm negotiating, I wouldn't sell below this price because this is my equity value. So that's one way to look at it. So it's like you're looking at best case and worst case. So typically, this should be your worst case scenario if you're looking to value your business. And there's also the market value. So market value is straightforward with one condition, if you can get information. So market value basically suggests that what you can sell this business for, or the value of this business, is what other people are willing to pay for it. So what you do is you then go to look for companies that are very similar to yours in every respect. So are they in the same industry? Do you have similar number of employees? Do you have similar asset sizes? And every other comparison we can use. So the question now is, what that business sell for? If that business sold for maybe, like the example I'm using here is $10,000, and there's been a trend that everybody in that industry is selling, around that range, and they're about the same size as you, you can then say, okay, this is the value of my business based on what's happening in the market. Now, the challenge with that, as I said earlier, is information. So if the company is not public, right? If the company is not public, you might not be able to get that information easily, especially if you are not in M&A. If you're not in the M&A team, the big consulting team. So M&A is mergers and acquisitions. So those guys get to know about deals that are happening in the industry. So like in Nigeria now, every day, people are buying and selling companies, but sometimes for privacy purposes, they do not want to disclose what they are doing. The only people mandated to disclose that information are publicly listed companies, that is companies on the stock exchange. So for instance, now MTN is now listed, so anybody has access to MTN's account. You can see what MTN makes. If MTN wants to do anything, it has to let the public know, because that company is basically owned by the public now. So yeah, that is the challenge of using the market value. Can you still hear me?
Yes, we can.
Okay, great. All right, so discounted cash flow is one of the most used by professionals, and it's the one that people like Warren Buffett recommends because it's based on cash. And you know what they say about business? Revenue and profits, they are both opinion, but cash is fact. Anybody can say they have a certain amount of revenue, or they made X amount of profit. But if it's not backed by cash, it really doesn't mean much. The challenge with this is if you need a business that is generating, decent and steady cash flow, and you also need to be able to predict the cash flow that is going to generate in the future. And what you do is you predict the cash flow ahead of time for, say, five years, averagely 5 years. You can do more. You can do 10 years. You can do, that depends on the particular situation. And then you sort of take the value of all those cash flows and you get what they call the net present value of those cash flows. That is, how much are those cash flows worth today? Now that gives you an indication of the value of the business. But like I said, and as many people have asked, this business is not generating cash flow. It's not profitable. It doesn't have to be profitable to generate good cash flow, by the way. So if you look at companies like Amazon, Amazon is profitable now, but for a very long time, they were loss-making. And they were loss-making, but they still had a very good initial public offering. And part of why people liked their business model is they were collecting cash upfront. So they actually had good cash flow because every time somebody orders for something online, they pay in advance before it gets to them. So cash was always coming in, but they were loss making. It's actually possible for you to have a cash generating business that is not profitable, but it has to be, like I said, steady and to an extent predictable. So in the next slide, you see some of the steps that we need to carry out. I was very careful in preparing this slide because things can be a bit technical for discounted cash flow. You can read on it. There's loads of information online about it, but you want to get the guidance of somebody that really knows what they are doing if you want to attempt preparing evaluation based on discounted cash flow. So if you look at the steps, so the first one is right now you have to determine what your cash flows are. And we're very specific when we say cash flows because there are some things in your business that are not in your books that are not cash flow. So if you have depreciation, if you have amortization, and those kind of expenses, you have to add them back because they are not cash related expenses. And then there are some other expenses that you incur that you might not have put in your income statement or profit or loss account, which is like your capital expenses. So if you bought a car for your business, you wouldn't expense everything at once. You would depreciate it gradually, but in terms of cash flow, you have to account for it as if it left at once. Well, you can read more on this. The core principle to understand is you are really focusing on cash flow. Now the next step is to then grow that cash flow, which is another interesting part of valuation that a lot of people argue about too. So there's always a lot of dispute as to whether the growth rate is correct, why you're growing your business at 10% annually, what are your competitors growing at, what have you done historically. It's always a very huge source of debate, but believe me, the difference between growing your cash flows by 2% and say 3% over the long term, it can be significant. Now, you have to also choose what they call a discount rate. Now, a discount rate, for purpose of simplicity, is the rate you are going to use to convert that future cash to today's value. So basically, you are saying that 100 naira that is coming in tomorrow, what is the value today? That's the summary. You also need to calculate what they call a terminal value. Terminal value can be summarized as how much will you sell this business in the last year of your projection. So if you do a projection for 5 years, you have to put a terminal value in that 5th year to say I can't make an unlimited projection. So let's assume I'll sell this business in year 5 or year 6. So my terminal value is how much will I sell this business for at that time. There's a formula to calculate that. You can easily get it online. So now to value this business, you take all those cash flows, you add the terminal value, and then you discount it to the present value. It's not as complicated as it sounds. We can't put all the formulas here because of time constraints and how technical it can be, but it's actually something that you can learn or get somebody that has done it before to guide you on how to do it. And then the value you get is what is called your enterprise value. But what you're really looking for is your equity value. That is the value of your shares in the business. Now, enterprise value is equity plus debt. So to get your equity value, which is the value of the equity in the business, you have to subtract any debt from whatever value you derive after doing this. So I'll move on to the next slide.
Hello, Tunde, we can't hear you.
Hello?
Yes, we can hear you. We're having challenges hearing you before, but we can hear you now.
Oh, okay, okay. Where did you lose me?
I think when you came to the beginning of the slide.
Oh, okay, okay. Sorry about that. All right. Yeah, so I was saying that multiples are very similar to the market method because most times people compare the multiples of similar companies or companies in that industry just to check what they are doing. And multiples is essentially saying, let me use an example of price earnings multiple. So it's saying that how much, so for price earnings, for instance, your earnings are your profit, right? So if your price to earning ratio is say 5:1, what that means is that people are ready to pay 5 naira for every 1 naira of profit you earn. So that is why publicly listed companies, people focus a lot on PE ratio, because they are trying to use that to gauge is value of this company, does it make sense? And let me use an example that some people were debating recently. So now Apple is one of the most profitable companies in the world, and I believe it's still the most valuable. So if you have, there was a time people compared Microsoft's, Microsoft isn't as profitable. People compared Microsoft's PE to Apple's PE. Now, if Microsoft has a higher PE, people then start to question a significantly higher PE. People then start to question why is a company that is more profitable, why is the PE less than a company making, significantly less profit? But it's very subjective, and there might be other factors to it. Again, the challenge with this method is it looks at profitability. So if your profit is 0, you don't have a PE ratio. And for a lot of businesses within their first 2 to 5 years, a lot of businesses are still making. So PE ratio is probably not a very ideal ratio for new companies. What a lot of small companies use is price to sales ratio. So the idea is that at least even if you're not profitable, you have sales. So what is your price to sales ratio? And I use some examples of some companies that use price to sales ratio because a lot of them were not even profitable at the time they listed. So Facebook, Twitter, LinkedIn, all used price to sales ratio when they were going to list, and all of them had very similar price to earnings ratio of about 12:1. 11, 10, 11, 12, around that range, between 10 to 12 was their price to sales ratio. So it was easy for each of them to justify to say, oh, Facebook, this was the PS price to sales ratio, and we're in the same industry, so it makes sense. Which is why this is also similar to the market one, because you're also looking around the industry to justify the price to sales ratio that you're using. And like I said, it also depends on other factors like the industries and whatnot. So like tech companies will easily have, 10 and above P ratio or price to sales ratio, whichever ratio it is, because the expectation is that they are going to grow exponentially. So they might grow at 30, 40, 50% annually, compared to a very stable industry that might just grow like 5 to 10% every year. So you expect the ratio for a lot of industries in stable companies in stable industries to be much lower than high growth industries. Now we move on to the unconventional methods. Now the unconventional methods, it's really where it gets very subjective, right? Somebody asked in the questions that is it specific or subjective? It is very subjective at times. And some of these unconventional methods is what makes it very subjective. So for instance, the first example is the management value, right? Just imagine you had a small company and you said Bill Gates was going to be, you had a tech company and you said Bill Gates was going to be your CEO. Now, even if Bill Gates doesn't drop a dime to start that company, the value of that company is already huge. People would just be very comfortable that, man, Bill Gates is on my management team, Dangote is on my management team. So what is the value that I place on these people? There are different ways to calculate that. You can use some subjective, you can try to be objective. You can say, how much does Bill Gates earn in a year? Maybe you multiply it by 5. Or what do you think having Bill Gates on your management team is worth? That one is very subjective, but it also comes into play a lot. So a very good example of how one of the recent transactions that happened was even the WhatsApp deal. So WhatsApp wanted to sell to Facebook, and they valued it at about $16 billion. But Facebook was willing to add extra $3.6 billion if the management team was going to come along with the acquisition. So that was the premium that Facebook was willing to place just to have the management team of WhatsApp be part of Facebook. So yeah, it's actually a very big deal. Not always very easy to measure, but it's a big factor. There are also some industry-specific valuations that people use. So for instance, if you are very bullish, you can use number of customers. If you have a lot of customers, again, one example was the WhatsApp deal. WhatsApp valued their business at about 42 cents, $42 per customer. That was how they got their $16 billion valuation. Even if at the time, they were barely making about $10 million a year, they were still able to sell their company for $19 billion, and they priced it per customer. But their case is peculiar because they had a lot of customers. At the time of the acquisition, they had over 400 million active users. So it might not be a very easy route to go, but if you do have very valuable customers, it's something you can bring to the table. Even if it might not be the only basis by which you'll be valued, but it's something valuable you can use to bargain with. Another industry-specific method is for e-commerce companies. They call it GMV, gross merchandise value.
Let me hear what?
Hello?
Hello.
Somebody said something.
No. I think I had to mute. I've muted the person. I think it was an accident. Go ahead, please.
Okay, all right. So for e-commerce companies, they use what they call gross merchandise value. Its acronym is GMV. A lot of people don't like that metric because it basically says that, so if for example, if Jumia sells if you go on Jumia now and you put your phone there, you put your phone at 50K and somebody buys it for 50K, even if Jumia only takes 5 or 10% of that value of your phone that you sold for 50K, Jumia can insist that its gross merchandise value is still 50K because those are the value of goods it has transacted, and it will then do a multiple based on that gross merchandise value. You can read more about it. It's very controversial. A lot of people don't agree with it, but a lot of e-commerce companies have been doing it, and hey, that's what it is. Entry cost is another method people use. So entry cost is basically, especially for startups, the investor or whoever is valuing you might just ask you that, oh, how much will it take for me to achieve what you've done so far? Especially if your business is the kind of business that requires money to be spent to start. So if you tell me that your business is valued at maybe 100 million, and then I look at everything you've done and I say, oh, I think for me to come into this industry and achieve everything you've achieved, I think I can spend 60 million. So on what basis are you telling me that your business is valued at 100 million? That is when you can then bring things like customers, things like your management team experience and other things, then push up your valuation. Then there's also intangible assets. So some people, some companies have some very invaluable assets like patents, trademarks, or licenses that a lot of people would consider if you want to dispose the business. They are very valuable. So a very good example is like the number of microfinance banks now that are defunct. A lot of them have a lot of bad loans such that they are not even valuable for their business, but they still have their licenses, and those licenses are still very valuable, and they can be sold for quite a bit. So that is also something to think about. The assets, intangible assets you have, like patents, trademarks, and other maybe copyrights and whatnot. So that is basically it on the unconventional methods. I prepared a slide for other tips. So it's very important for valuation to make sense. You need to keep very good records. We spoke about doing an asset-based valuation or cash flow valuation. If you don't have, hello?
Yes, we're here.
Okay, if you don't have very good financial records, tax records, every other record you need to run your business, it will be difficult for you to justify any valuation, because usually when you present a valuation, sometimes investors will ask for some of your books and then they want to carry out their own valuation as well, just to see if what you've said is reasonable. So you need to keep very good. Then again, sometimes you can't do just one valuation method. So most people will do 2 or 3 just to get a range of how much it is worth. So sometimes some people will ask you for a range of price, or you for your internally for your negotiation, you want to have something, a basis to negotiate with. So if you do 3 methods, you probably have one that is very high and one that is very low. Now you can then say, okay, you start from the high point, and then internally with you and your team, you just know that, oh, the valuation that gives you the least value for your business, yeah, that's going to be your bottom price. So it's usually best to do multiple methods. Then you also need to get an expert to help you, depending on the scenario. So if you are submitting it to like a venture capitalist or maybe a bank or somebody very formal that is not friends and family, they want to see a thorough job. And quite honestly, some professionals do some really good job. They can help you put scenarios, they can help you run multiple types of valuations, and it just makes your life easy. And you just come and you look at it and you tweak it a bit. But obviously, having this understanding of what you're looking at even helps you critique what the expert has done. And then the last is negotiate, negotiate, negotiate. So it's very important that whatever value you put on the table, anybody gives you, you negotiate as much as possible. That's what will determine how much you walk away with at the end of the day. Fine, the formal valuation gives you a good starting point. At the end of the day, you need to be able to determine, negotiate to determine how much you walk away with. Because some people will just say, look, they're giving me $100 million valuation, but I think your business is only worth 50, and then you guys will start it back and forth. It's almost like pricing something in the market. It can get that gritty and granular sometimes. So that is all for the main slides. I'm going to address some questions that were sent in earlier. Oh, I didn't get to address this question. This question is not directly based on valuation, but the answer to this basically is there's no straightforward answer, but the trick to knowing when to hold and when to sell a stock. So two things you can look at. One is you can look at your why did you buy that stock? Did you buy it to hold for a long time, or did you buy it to make a quick trade? Now, if you bought it for a long time, you might want to hold it if it hasn't met your expectation. On the other hand, if you had a specific target to say, look, I'm buying this so that I can make 20% return and I quickly want to sell, if you make your return, it's usually advisable that you exit out of that trade pretty quickly so that you don't get greedy. But a lot of holding a stock or selling is based on future expectations, really. And future expectations is based on how much information you have. So what do you expect the price to be tomorrow or next tomorrow and whatnot. So yeah, I just chip that in. I lumped up 3 questions here. The first is, which is the best method for valuing an SME without regular cash flow, e.g. a good processing company? How can I value a startup? Can you value a company that is in a startup mode? Similar answers. So I've said that revenue multiples is a good place to start. If you don't have profit, but you have sales, I want to believe you have sales, you can actually put a good multiple based on what similar companies have sold for, or you pick a number and then you try to justify it with the help of an expert. But if you have sales, revenue multiples is good because it's not so subjective. Well, the revenue itself is not subjective, but the multiple would then be subjective to a certain extent. Market comparables are also very good if you can find them. So you want to look for similar companies that you can match like for like. You say, oh, management team, we have similar experience with them. We have similar number of customers. We have similar number of employees. These guys are valued at 70 million. Therefore, I should value at 75 million because we have XX more than them. That's also another method. The easiest most times, so if you don't have good revenue, you don't have market comparable, you might want to then justify how much value you and your team bring to the table. Now, this one is extremely subjective because it really depends on your past experience. So if Mark Zuckerberg quits Facebook today and he says he wants to start a new business, people will basically be begging him with money, even if they don't know what he wants to do, just because it's Mark Zuckerberg or somebody else in Dangote, Jim Bovia, any well-established entrepreneur. And it doesn't just have to be a well-established entrepreneur. It can also be a very renowned executive in that industry. So you look at somebody that's raising up to be the MD of a bank. If he says he wants to start a new business, he can basically tell the person that, look, you can't value me at, even if I'm the only employee, my business can be valued less than the salary I'm going to take for a year, for instance. So that is very subjective, but that really depends on what you've done before and how much you can sell it. Other questions: how do I evaluate the worth of my business in deciding equity to give to an investor? So you can see the previous answer for a bit of insight into that. The easiest really is to ask for how much you need, and and try to justify it. So if you tell somebody that you want to give them, they should pay $100,000 for 10%, you're basically telling them that your business is worth $1 million. Now the question is, can you justify it, and also how well you can negotiate. So sometimes it just comes down to negotiation. The person is probably going to counter to say, no, I can't. If I'm going to buy this, I can't give up. I can't buy 10% of your business for this amount. Give me 30. You guys say no, give me 20, and then you go back and forth like that. Usually you should have a predetermined place for where you want to stop, beyond which you wouldn't go, beyond which you wouldn't want to go. Now that's based on several other factors, like has family invested in your business? Do you have agreements with other shareholders that you're not going to sell more than this amount? So it's really a decision you have to take on your own. It's not there is no rule book for saying how much equity you should give out. It's usually what you can live with. And the last point I made is, at the end of the day, you want to think about it without losing control of your business, right? You also want to think about, do you want to own 100% of a small company, or do you want to own 1% of a very big company? If you own 1% of a very large company today, you're better, money-wise, at least money-wise, you're better off than owning 100% of many other small businesses. The question is really what's important to you. Are you happy with saying, oh, I own 90% of this business? Does that give you comfort? If that's what you want, then please don't sell more than 90% of your business. But typically, when people are going to raise, generally, when startups are going to raise capital, they usually give 20 to 25% for somebody that is bringing in substantial money. So VCs will typically ask for 20 to 25%. So that's a good guideline for where you can start if you're not sure. At what stage do I need to value my company? I think you should always have an idea of what your valuation is at every given point in time, because you never know when that might be useful. It doesn't have to be an exact figure. You should just have an idea based on what you've done before and what the market is saying for similar businesses and whatnot. It's the most critical point of when you need evaluation is when you want to raise money or any of those reasons I gave before. But typically you should just always have a value in mind, no matter how rough or how crude your calculations were. But at the point you really need it is when you want to raise money for your business expansion, and somebody is asking you, how much do you need? If I give you 1 million, what percentage of your business are you going to give me? If you don't have a evaluation for your business in mind, when somebody is asking you those questions, you won't be able to have a meaningful conversation. What are the basic principles for company valuation? I've covered that. And how can you value goodwill of a company? This one is a bit tricky. On your own, you can't value goodwill. Valuing goodwill comes when you do what they call a business combination. When one company buys another company and they pay more than the net assets of that company, the excess of what they paid for is the goodwill. You're not allowed to generate goodwill on your own again. So you have to actually purchase another company, and that company has to purchase you to generate goodwill. Is it truly an objective exercise? The debacle will be work and what not. So it is never subjective. It's usually it's more objective than not. It can be objective when you are using those methods I covered, but at the time you're supposed to drop money, it becomes very subjective. There are other factors people look at. People, especially people look at, perception of the people in the management team. I can't stress that enough. And then perception of the industry at the time. It's just like now, there's so much buzz about logistics because of OPay. So All Right, Okada, they're all raising money. All Right, Okada, Max, they've all raised, each of them have raised at least $5 million. So if somebody's coming in now, somebody's saying now, but look at these guys, they raised $7 million. And you're like, maybe that's what is the in thing now. So those things drive how much people perceive the value of a business. What are the key things to look out for in order to know if a business is valuable? Cash, cash, cash. You cannot overestimate the value of cash. Valuable assets like patents, trademark, and a proprietary technology that the company might have that nobody has in case of technology businesses. Sometimes the customer base, if it's very large and valuable, then management skill, I can't stress that enough. Does one need a professional to value one's business? If you need it for just yourself or you're negotiating with friends and family, you probably don't need a professional. But if you want to go and submit it to a bank or a VC, you might need to get an expert to do something very clean and nice for you. So besides selling, what other thing? I gave a number of examples. One of the ones I've seen it play out over and over again in shareholders disputes. You want to break up from your business, or you guys are having issues with paying dividend. Everybody wants to know, what's the value of this business, so that if I'm leaving, this is how much I'm taking out of it and whatnot. And that's the end of the session. I'll take any other comments or questions. Thank you very much. You can find me on the Kleos Africa website, and you can also reach me on LinkedIn and every other social media platform. Thank you.
Hi, thank you so much, Tunde. This was very insightful. I already got some feedback from the participants offline that you obviously know your stuff. So you were very detailed and at the same time, very clear. So we're thankful for your knowledge sharing this evening. Okay, so there's a question from Ejuru. I think Ejuru is the CEO of Knickknacks Granola. And she's asking if there is a typical time frame for how long an investor should be vested in your company.
An investor should be
vested in your company. So like how long should the investor be a part of your company?
Oh, okay. Yeah, that's a very good question. Thank you, Ejiro. So it depends on the type of investor, right? Some investors want to be with you and the type of business too. So if an investor wants to be able to earn dividends from your business, that's dividend is profit reserves. That's a share of the profits of the business. It will it's likely that they want to be part of that company for as long as possible, because dividend is steady. If dividend is steady and it's coming regularly, right? Or if that's the plan. Now, for most other investors, current type of investors that I suspect you're referring to, which are venture capitalists,
says equity investor, like an equity investor.
Equity investor, yes. Those guys typically want to stay for 5 to 10 years. Now, the idea for those people is, if you tell, when they're investing, if you give them a valuation of, say, 1 million naira today, the idea is that you should be able to sell this business for 10 million naira in the next 5 to 10 years, so that they can make 10 times what they invested today. So typically, those kind of investors typically want to stay 5 to 10 years, because they also have a timeline to report the capital gain on their investments. So the idea is, let me invest in Ijuru now. Our business is worth 1 million naira. She's a very good investor. She knows what a very good entrepreneur. She knows what she's doing. In 5 years, she would have grown this business to a 10 million naira business. We'll sell the business and I'll get 10 times my return. So it's typically like 5 to 10 years.
Okay. I think that was clear. That's clear enough. She said thank you. I think she's clear now.
All right.
All right. So okay, before we log off, I would like to thank everyone, first of all, for joining the webinar and staying till the end. I'm sure we all managed to take away 1 or 2 key points from today's webinar. For next steps, I will be sharing the slides and the recording with those of you that are on the WhatsApp group that we created. If you didn't make it to the WhatsApp group, maybe you didn't share your WhatsApp number, I will email you a link to the Kleos Africa blog where you can access the recording. In addition, a number of you indicated that you are interested in valuing your company. So we have different price. So if you're interested in valuing your company, we have different pricing options from the do-it-yourself model. So we can help you with the software and you just plug in the numbers yourself and do it yourself for a token fee, or you can get a consultant of Kleos Africa. Kleos Africa has a number of consultants that have valuation skills. Of course, Tunde is at the top of the pyramid, but you know, should you wish to have his help, he can help you. We also have a couple of other consultants that can help you with valuation activities. So do reach out if you want to take the conversation further. And I look forward to having you on the next webinar. Interestingly, the next one is about securing capital, and yours truly will be taking it. Securing debt investment and equity investment, both from local and international investors. So thanks everyone for staying till the end, and I hope to see you on our next webinar. Thank you so much. Bye.
Bye.